Yeah, but the budget weren't too many
wasn't as
changes,
much wasn't as much in it as I would have thought for from a tax point of view. Anyway, there are a few big ticket items that don't really impact the work we do, but
and it was more a bit of a welfare budget, looking after mental health and women's health and aged care.
The NDIS got a big
vaccine distributions
well.
and
yeah. So no, I mean, all that's important, and obviously big dollars being spent, but don't really impact on the work we do for our clients too much. So we won't dwell on them for any great length of time. So there's probably three areas of the budget that we will actually run through. So there's some personal impacts, a few business impacts, and some superannuation matters that came up. So we'll go over those in those sort of groupings. On the personal front, it was pre-announced probably a couple of months ago. They said they're going to do it anyway, but so it's no surprise that the low and middle income tax offset's been extended for another year. So middle income earners up to $126,000. Well, it's up to $90,000. You get the full rebate of $1,080, but people up to $126,000 will get some sort of rebate out of that.
And the real rebate, I guess, the big change is government's committed in 1st July 24 when the next rate changes happen for individual. That'll be from 40,000 onwards to 2,000, only 30%. So that'll have a big impact from the 25 financial year. So that's a few years away yet.
Yeah, there's one, possibly two elections to come before that.
But other than that, the Medicare levy remains at 2%, so that's unchanged as well.
Yep. Yeah, I guess it wasn't the year for it now, but there might well be like a budget repair levy or whatever they called it 5 or 6 years ago. That might pop up some stage soon.
Well, it may be another levy to pay for all these vaccinations. Who knows? So anyway.
So just flowing on what Jarrad had to say there. So no change in the personal rates at this stage. The stage 3 changes to the marginal rates that were slated for the 25 financial year, that's still to come through in that year. So that'll likely be an election issue, whenever that may be called. Self-education costs. So usually the first $250 is not deductible of any self-education costs, but they're waiving that measure. I don't know how many people that'll truly impact.
Just to make it simpler and easier.
Yeah.
I think a lot of people, they used to get around that anyway, circumvent it via just motor vehicle 250 or something. So,
if I'm going to cop that, I'll make it back somewhere else. But and I guess the one that needs more detail is they're going to clarify how they define tax residency, but very little detail really provided in the budget papers. It's more a matter of watching to see what comes out in the proposed legislation there. But
and well, what they're suggesting is the primary test used to be the domicile test, but now the primary test is the physical presence in Australia 183 days or more to be taxed on worldwide income, and then secondary tests looking at physical presence and other areas. But as you said, they're still looking at that, so we'll wait till things are legislated there.
Yeah, right. So that's they're really the personal impacts from the budget as far as tax measures are concerned. The business impacts. So not necessarily anything super new in the tax front, but there were a couple of extensions to the full expensing of capital assets. So that's the ability to write off depreciable assets that you acquire in the year of purchase. That's been extended to 30 June 2023. That's for all business with turnover up to $5 billion. So it's just about everybody. And then also the
but
loss
another
carryback.
thing, Jason, it comes, and I talking about the other day with a colleague, it was people think it's a big benefit out there. Yes, it is an immediate benefit, but it's one off. I mean, you're getting the deduction up front. A lot of people think it's like tax relief, or they're getting extra rebate, but it's bringing forward that expense. So they got to understand that, I guess.
Oh, look, I think the real sting in the tail's yet to come, and that's when they buy their UB car for $100,000, get the $100,000 deduction this year, and they trade it for $50,000 in 4 years' time. They've got to pay tax on that 50.
Yep.
That's I don't think anyone's even given that 1 second's thought. So I think that's worth mentioning to clients when they're, well, certainly when it appears they're just buying a car or whatever just for the sake of getting a deduction.
That's it. The sting in the tail, like the JobKeeper, fantastic, but it's accessible, so there'll be tax on it.
You'll be getting some of that back anyway. Yeah, correct.
We're just going to make sure clients are aware.
Yeah. And the other measure that was extended, I should say, was the loss carryback rules. And I guess they're really intended to operate hand in hand with the full expensing. So, if your client had a big spend this particular tax year, put yourself into a loss position because you bought a significant item of plant, you can really get the cash flow benefit by claiming back some of the tax you might have paid in
the 19 years.
The 19 year. Yeah, correct. So if you paid tax in the 19 or the 20 year, and you make a loss in this 21 year, or you made a loss in the 20 year, you can go back and claim back some of that tax you paid in a prior year. So that'll basically just run for an extra year. So that'll go out until 30 June 23.
Yes, that's something we'll look at for all clients this coming tax planning season.
Yeah,
it certainly will help cash flow.
Yeah, and we'll just remember with the loss carryback, it's only for companies too. Doesn't apply to any other sort of taxpayer. A couple of smaller measures, they'll affect some people that we deal with, and to some degree, but not a massive or broad impact. One is the ability to self-assess the effective life of intangible assets like in-house software or registered designs and things like that. You'll just you'll be able to form your own opinion as to how long they'll have economic value to the business and write it off over that period.
Yeah, no, I think that comes along like the last 20 years. We're just in a IT revolution, and I mean, patents are 20 years, but some patents are 8. But these days, you self-assess because a patent might only be relevant for 4 years. So I guess
somebody can trump it with new technology. Yeah, correct.
So it gives taxpayers the ability to self-assess on reasonable grounds.
Yeah. I didn't realise this was such a big sector, but digital games. So developing games is apparently a $250 billion industry worldwide, and Australian government would like our little gamers to get a chunk of that. So there's a 30% offset they're proposing to support businesses that operate in that sector.
And keeping in mind, you've got to have a minimum spend on qualifying assets of $500,000. So
so it's not somebody building a little solitaire app on a mobile phone. It's got to be a little more substantial than that, I imagine. But anyway, that's I'm sure that's welcome assistance for the 4 or 5 businesses that do that sort of thing in Australia.
But it's good for promoting
as opposed to vaccines for retirement homes.
Well, the people in the retirement homes probably need to be able to play games to take their mind off things. It's virtuous. The next thing, there's a, call it a tax break, but it's internationally the concept's known as a patent box. And the concept here is being applied to businesses that develop patents in the biotech or medical research sectors. And the way they operate is to make sure that earnings off those patents would only ever be taxed at 17%. So it's to, I guess, recognise that this sort of research is long term and high risk, so that if it does come to fruition, there's a recognition in the tax rate for a given period. And you also remember patents don't last forever either, so it's not a 17% tax rate forever and a day. It's just for the life of the patent. But
a rate like that makes you attractive amongst other countries out there. So,
look, I mean, the UK patent box rate was 10%. They've ratcheted that up a little bit recently, but it's 17% is probably for that patent box sort of stuff at the higher end still. Probably a welcome measure for those companies nonetheless. Couple of more administrative type measures. One was to give the AAT powers to tell the ATO to step down on debt collection activity if there's a dispute as to that particular debt. So if it's a matter that's still going to go before the AAT for whatever reason, the ATO could be told they're not allowed to garnishee or otherwise pressure for collection of debt until the AAT has made their decision on the matter, which just stops the ATO from being a bit of a bully, I guess, in those sort of situations when people don't have the resources to necessarily meet those assessments and also carry on the fight.
Probably. It's probably not an announcement the insolvency experts welcome, but that's, it helps many businesses there.
They've had a rough ride lately, the insolvency guys, haven't they? They haven't had the tsunami of failing businesses they were hoping for. And the other one was, I mean, there's detail required on this. It's just a bit of a throwaway line, I think, in the budget, but they are looking to enhance disclosure around franchises so that people that are looking to buy into a franchise get as much information as they possibly can.
It's not a bad idea, because I think the franchise in the last few years hasn't been as attractive as it used to be. It just is,
I've never liked them. Never liked them at all. But there's the odd sort of franchise that does okay, but by and large they seem to operate for the benefit of the franchisor, and the franchisee gets a wage, if they're lucky. So
all the covenants and the fees, they're just restrictive at times, and that's why the small business of Australia just going out on their own.
It's an easier proposition. All right, so that was the business impact. So in super, a few things happened. None of them are, I guess, massive in their own right, but a few different things popped up. One was the minimum earnings threshold for employer super, mandatory employer super, has been scrapped, effective from 1 July 22. A lot of these measures are effective from 1 July 22, and this the old $450 minimum earn in a month to qualify for mandatory employer super is being removed. So now, if you employ someone and they have ordinary time earnings, you've got to pay their super.
And originally that was brought about administrative, just that threshold amount. But now with STP, single touch payroll, it's easy. So
it's no real different to a $400 earner to a $4,000 earner. Your payroll program will still pick up the right amount of super easily enough. This is a big relief, and I know that I'll be a lot more comfortable not having to justify somebody working when they're 73. Trying to say they work 40 hours on the family tractor, getting around doing something or other. But removing the work test would be and ease an administrative burden. So basically, anyone up to 74 can make their contributions, just subject to the normal caps. Really.
No, I think that's fantastic, especially with the ageing population. And you're right. Clients would try and you'd believe them, but were they really retired, or who knows? But now, makes it a lot easier.
Just having to jump through hoops for the sake of it's a silly proposition. But, that was a good one. I was glad to see that one's gone. But once again, not until 1 July 22. So The charade will have to continue for another year, nonetheless. The downsizer scheme, so that's where a person can sell their home and presumably move into something smaller and easier to maintain as they enjoy their retirement, and that enables them to put a chunk of money into super. That was only up until now, or well, up until 30 June next year. In fact, is available for people over 65. Yeah, but from 1 July 22, it'll be available for people over 60. So it'll widen that net a little bit. I don't know why they waiting a year and a bit on that. I mean,
yeah, it gets more money out in the economy, stimulates the economy, the housing market.
Yeah.
You've got to have less than 500 million superannuation balance.
500,000.
Yes, correct. Yeah, sorry, Joe. Yeah, but so there's some eligibility criteria, but yeah, I think that's a good one. Downsize. I mean, my for example, my folks are doing that. They're moving out in the next year, moving out of their house, which is too much to look after, into a unit. They're going to make. So I think
moving into you, huh?
Yeah, no. At least
go to Rocket Court.
No, but he can still look. He can still look after my maintenance house, so he's still got a job.
I was going to say, is he build a cabana out the back of your place?
He just put some walls on the one that was already there, Steve.
Yeah, no, that's his first job. Yeah.
It's also worth pointing out that the downsizer scheme doesn't impact on the non-concessional caps. So you've got both of those measures available to you if you've got a particularly low superannuation balance you want to try and top up in a hurry. First home super saver scheme was capped at 30,000. They're increasing that to 50,000. But you still got to put the extra money in there to start with. Then you can get it back out if you're ever going to be able to get into the housing market as a first home buyer. Maybe when some of these downsizers start getting out.
And then another incentive program, I guess, to stimulate the economy. Australia's got the most super locked up, I guess, in the world. So yeah, it's a good measure, I guess. I mean, it's the Australian dream, isn't it?
Get your own home. Yep. What's the next one? SMSF residency. So the safe harbour test used to be a 2-year period. You could be potentially absent for. It's now a 5-year period, and they're removing the active member test as well to try and make it a little easier for people that temporarily find themselves out of the country while on a some sort of work engagement. I don't know who's leaving the country right now. I don't know who benefits from this, but also you're on the call. I think we've got one client that would have liked this in place about a year ago, but
that is true. Although there is still the question of intent, which when it comes to superannuation law might be a problem. So if you're leaving with the intention of not returning, then you don't get any sort of extension of that. Under super law. Tax law is different.
Yes. So is the law as it pertains to ASIC. So when you've got these residency issues, you've got 3 things to consider. But anyway, that is supposed to simplify things for all the people that are running around the world at the moment, doing what they do. What did I do? I just skipped the wrong one. So
not so much more the next year with
that's right. No one's anywhere. That's
except Australian cricketers. Anyway.
Australian cricketers, they can move around.
Just on super too.
Wait, there's more.
No, it's just this was always legislation, but it's 10% increasing the superannuation guarantee.
That's one of the future slides.
Sorry. Okay. I jumped ahead. Well, we just talked about super. We're on super.
Yes. So just some other budget measures that might be talking points, or they're certainly in the media to some degree. The aged care sector is receiving a pretty substantial funding boost to try and get more people interested in working in the sector and try and increase the number of hours or minutes per day each resident gets as direct care. Childcare subsidies are increasing, particularly for people with multiple children in childcare. The NDIS budget's being expanded. There's at least 10 billion committed to large infrastructure projects, but that is over about 10 years. So I guess in an annual commitment, it's not as big as some of the other measures that we've talked about. And I guess one that sort of was in the fine print, but might impact a number of our clients is the potential for government contracts. They're really focused on trying to open them up more for small businesses rather than just the big end of town being able to meet the various criteria.
Yeah. Yep. And of course, the other things, obviously, digital health and mental health have sprung on, especially with the advent of COVID.
Well, that was sort of the unknown impact, wasn't it? How much people suffered with stress and loneliness and depression through it all.
Still suffering.
Still suffering. Yes. Some other measures, I mean, that are already announced or that carry over from the last budget, which was only a bit over 6 months ago anyway, but they're pertinent to our tax planning that we're going through. The small business or base rate entity tax rate reduces from 26% to 25% for the next financial year. That also means the franking rate drops again. So just be mindful of.
And as we know, it really makes companies a real attractive
25%
vehicle.
Yeah.
With 25%, even if you're in a trust and you get the discount, the capital gains discount, 25%, it's locked in there. You can park it in there. Versus, I guess, trust as operating vehicle. It's got its issues, but anyway, the company 25%. That's There's
plenty of lawyers that now start advocating companies as longer term holding entities, but it's important to remember that 25% rate won't apply to property investments because that's not base. It's not a base rate entity if you're if you're getting rents.
Yeah, good point.
You're on 30% still.
Yep, good point.
This is the one Joey was alluding to just before. So come 1 July, the mandatory employer contribution rate for super goes up to 10% from 9.5%. So that wasn't a budget announcement. That was just previously scheduled, and there was a bit of talk around the traps of employer groups in particular were trying to pressure the government to repeal that. But there's no mention of it in the budget, so it is going ahead. So the rate will be 10%, a bit easier for us to calculate. That's a positive. But that'll kick off from 1 July, and it'll go up 0.5% a year after that until it reaches 12%, where it's currently envisaged to stay until the next government wants to have a crack at it. Just on that though, I mean, it ties in, I guess, with the caps are going up. So the concessional cap becomes 27,500 next year. And then that leads on to the wage level at which you can opt out of employer contributions is 275,000.
Right. Yeah.
Which is the 27.5 divided by your 10%. And then you've got the job trainer scheme already in place. So that's the apprenticeship subsidies and various vocational training initiatives. They're seeking to expand that by another 163,000.
No, it's a good program, but it's hard. I guess you got to fit the eligibility. I guess the one that people seem to trip up on more than most is you've actually got to be increasing your head count. Right. Yep.
And so, from a comparable period last year or whatever, you might have had 25 odd people. You're down to 20, and then you just put a trainee on. You might not qualify because you haven't got the right head count increase metric. Anyway, that was most of the budget measures as they might impact our part of the world. Does anyone have any questions or comments or on any of that, or anything we might have
In the chat.
skipped over or missed?
So with that additional super, will that be effectively an additional cost of the employer?
Yeah, it's however they structure it. Like if it's in their total remuneration package, if it includes super, well, you know, the employee basically the same, or if it's on top of their wage. So yeah, it'll have to be structured in when employees negotiate with the employees on their.
Whatever their gross wage is it's 10% of that's got to be paid in super. So
Yeah, but if they have an existing salary that's including super, will they then all of a sudden be out of pocket, the employees? I mean, existing employees, obviously new ones are easy, but.
Yeah, that's right. So it depends how they, if the employer says your remuneration package is this X, well, yeah, it is. You're right. Yeah, so they would.
That's going to be a bit of a surprise to a lot of people.
Yeah. Oh, yeah. If it doesn't, that's right. Yeah, so they could have less in the pocket where they operate in that manner. That's spot on.
Huh.
Yeah, so in wages don't look like they're going up in a hurry. Not much CPI forecast. So yeah, that could be a little hit. So yeah. Yep.
anything else?
No.
No.
Alrighty.
All right. Well,
thanks, Jace. Thanks, guys.
Thanks, Joey.
Thanks for listening.
Thanks for dialing in.
If anybody out there ever listens to this, thank you.
All righty. Thanks, guys. Take care.
Right. Actually, there was a couple of clients. There was